We were discussing what led to yesterday's rally. Was it really the Fed? Was it shortcut? What was happening? So what's your explanation before we even get into what's going to happen next?
Yeah, so another episode of As the Fed Turns here. I mean, this, and just to be clear, Andrew, this wasn't, Joe Namath guaranteeing a rate cut here. I mean, this is a Fed that, to his credit, when things are getting very volatile, just saying, we have your back. But I want to be clear on a couple of things. First, things have to get worse for the Fed to cut rates here. Either worse of them missing their inflation target, which is 2%, or even worse, the administration imposing tariffs on the $300 billion, which would cause a really bad downtrade. So we're almost saying, you know what, this is an environment where you don't want the Fed to cut. You want the Fed to stay at neutral, because if they were to cut, it would have to get worse. The reason for yesterday is I think a lot of the market got really short. Things don't move by 500 points because everybody's invested. I think the market is really short.
So, but isn't this just so perverse, though? Because people are expecting things to get worse and then they're going to be saved? I mean, is that what's happening?
The strongest tool the Fed has is its ability to communicate. And so when you look back to December, when they were still talking about a potential tightening, and any weak or any lowering of rates was not on the table, today they're having to change their communication, and that's what we're seeing.
But the Fed futures are 97% that there's going to be a cut. You don't think there's going to be? You say that's wrong.
It would have to get worse for it to come through.
Well, how do you know it wouldn't have to get better in terms of inflation, or worse in terms of inflation? How do you know it's not a growth story? It hasn't been a growth story at this point. We've been at 2% with GDP at 3%, or above, and unemployment below 4%. So at this point, it's been inflation-based, right?
Yes, it's been inflation-based. But, Joe, the Fed's meeting their mandate right now. Right.
So why,
in terms of their full employment and price stability, we're a little bit below 2%.
They were talking about that a lot yesterday. That they're below.
Right. So if things were to get worse on the inflation front, that wouldn't be good for stocks. If inflation were to, I mean, look at where all these central banks are doing. They're struggling to get inflation at target. And Fed funds, Joe, isn't the magic elixir.
But shouldn't wage gains in the tight labor market and, God forbid, even some of these tariffs, shouldn't that give the Fed some leeway in terms of inflation? Shouldn't we be able to, normally you'd be worried about it, but in this case, you might hit 2% from the underside and actually go a little bit above it.
I think tariffs would be more of a growth hit than an inflation
More than growth than inflation. But what about wage gains in the labor market?
Wages are at cycle highs, but nowhere near where they were in prior cycles. I just think the Fed's, there's a little bit of an overreaction right now, and what the futures market is indicating to you, 97%, seems more of a crisis mode for the Fed than them having to do something.
Nobody understands it, but it seems...
You're betting the opposite direction, it sounds like.
We think that the underlying, the economy, the fundamentals are weakening. We think the Fed's going to cut in the fourth quarter. We see 50 basis points.
And let me ask you separately, because we haven't really talked about it. We were talking about tech earlier. How much of this tech wreck, which is bouncing a little bit, in terms of how you're thinking about tech and regulation, and how you think that that's going to ultimately affect all of these?
Yeah, so I think people got lured into the FANG stocks as being a flight to quality trade, almost treating them like treasuries, right? If you want to own stocks and you want to be safe being FANG stocks, tech has a lot of beta to it. Tech has a lot of risk to it. So this is just one more thing, not just the tariffs, but also the regulatory issues, that we would be a little bit cautious on tech here, and couple that with stuff that gets yield. I think yield is really important.
If tech's not leading the marketplace anymore, what's going to be?
Anything that produces a yield, Becky. This is a world with the 10-year notes at 210. I mean, give me a break. You got to get yield somewhere.
I think when China gets fixed, not if it gets fixed, when it gets fixed, tech's going to rally.
China gets fixed, tech rallies, irrespective of whatever regulatory overhang you think there may very well be in terms of what the FTC or the Justice Department may or may not do.
Because success for the tech sector is actually being able to compete in China.
We saw this already. We saw it in October when Apple warned about China sales. FANG stocks got obliterated until we did the December 1st timeout on trade, and tech started to come back. So I think.
How are you playing this Mexico situation? Would you want to own automobiles right now?
No.
Would you want to if there weren't any tariffs with Mexico?
No, and that's no. We talked about that last time. So part of the thesis we're looking at also are these mass layoffs that we saw with Ford last month. Today it's Volkswagen. They're coming.
I think it shouldn't be understated, though. Again, the 10-year note at 210. Financial conditions have eased incredibly this year. Stocks are up double digits. The 10-year note is 100 basis points lower. People are forgetting just how easy financial conditions are. And the 10-year note means more to the average American than a federal funds rate ever will, because it controls the housing market.
If you're retired and living on fixed income, you might buy GM.
Yeah.
It's at 4.25%.